Today I'm going to talk about a study that was recently done by a very large advisory practice out of Texas. They managed $3 billion in assets, and what they were trying to understand was who of their clients got the best returns and why did those clients get the returns that they got. Now, we manage money at Bear Wealth Management almost in the exact same fashion that this firm manages money, and that is what this is what that firm found. Going back to January of 2008, so they wanted the full calendar year of 2008 where the market crashed and was down from peak to trough of about 50%, all the way till December 31st of 2014. Who of their clients got the best return? Well, the clients that followed the advice of this firm received 101% of the benchmark's return. That means that when they came in and they were deemed to be a moderate investor, they were a moderate investor from 2008 until December of 2014. They didn't change their risk band. Those that didn't do that achieved an excess return over and above the benchmark. They did that by rebalancing and really by staying disciplined and weathering the good, the bad, and the indifferent. Those that somewhat followed the advice of the advisor, but changed at least one risk band, meaning they moved from a moderate growth to a moderate, or from a moderate to a conservative growth. So they didn't go way off the charts, but they either got more conservative or got more aggressive. Could have been the exact opposite. They only got 85% of the benchmark against what they were up against. So they were taking the advice, but adjusting based probably, most likely, on market conditions. Those that thought they knew best, those that really went from either ultra-conservative to ultra-aggressive, jumping more than two risk bands, received 68% of the benchmark return. Now, why is this important to you, the client? And what it shows is that discipline and patience and time is how you get this excess return, when you're doing things the right way. This is where an advisor showed, there was a study by Vanguard that showed clients who work with advisors average 3% per year higher return than those that don't. And they do that because they follow the advice of the advisor and they stay disciplined. Those that end up acting like this still had an advisor and only received 68%. So imagine those that don't have one at all, what kind of return do you think they're getting? And studies have shown that it's around about 40%, as the market did 9-some-odd% over the period of most Dalbar study, and the average investor did just 3%. So think about those in those terms. I think today, where I'm recording this on Thursday and the market's down very big today, is one of those days where it tests your patience. And the only way to have success, and whether it's investments, whether it's your business, whether it's your family, whatever it may be, is to have discipline, a goal, and to take step by step to get to that goal towards the end of the day. Call us, 770-984-2312. Go to our website. You'll notice some changes. We're going to have a big launch here coming up at bearwealth.com. Until next time, have a great week.